Probably the number one request I get on this channel all the time from great folks like yourself is, how do I acquire a duplex or a triplex or even a fourplex? Well, because they want to be able to live in one side and rent out the other side, so they can not only reduce the cost of where they live in that moment, but also, more importantly, build wealth over time as they build equity and having somebody pay for the mortgage along the way. So a great strategy, of course, is trying to find multifamilies. Well, the problem with that is there's just not that many of them. And the strategy breaks down because even the ones you can't afford, they get bid out from under you by aggressive investors who are buying with all cash. So it's really not a legitimate strategy in practice. So what I tell them, and what I'm going to show you now is an alternate strategy that's going to help you build wealth by accumulating single family homes over time, build a great portfolio, and have massive wealth, massive equity by the time you retire or even before you retire. So if that's of interest to you, let's kick off this rodeo right now. Hi, folks. I'm Kevin Fagan, the Mortgage Patriot, on your side, nestled here in the hill country above San Antonio, Texas, serving all you proud Texans and all you great patriots all around the country. So an important video today because we're going to talk about a very popular subject of, hey, how do I build wealth? How do I get rich? How do I get wealthy over time? And because I don't make seven figures, I don't even make six-figure incomes. I'm just a working kind of guy and gal, but I want to be able to figure out a way to provide for my retirement. I want a way to have cash flow 20 years from now or 15 years from now, 10 years from now by acquiring real estate. How can I do that? So I'm going to answer all those questions today. Hit the like and subscribe below. It really helps me build my YouTube channel. You can see I talk about all kinds of subjects, how to finance certain types of homes, how to use an FHA or a VA loan, or what is the best loan to use. And in the case of this video, how do you build a strategy of single family homes to create wealth over time? So again, hit the like and subscribe, even comment if you would, and let's get into that content right now. So there's two big reasons or obstacles, challenges, if you will, of trying to start investment property purchasing using, multifamily. I mentioned one of them, of course, and that is the availability. If you're trying to find a duplex or a triplex or a fourplex, it's very hard to find them, number one. So for example, every about 50 single family homes that are available in the market, maybe one might be a fourplex, or one might be a triplex. One out of 25 homes might be a duplex. So they're very hard to find. And if they can be found, if they come to the market, and if they're a decent deal at all, they're snatched up right away by institutional buyers, and usually with an all-cash purchase. So it's very hard to compete against them. You have to be very aggressive, and it just doesn't work. I mean, I've tried this over and over and over again in my market, and probably y'all can tell me in your comments below, maybe your efforts. Very hard to do. The ones that you do find are all beat up and you need a renovation loan. It becomes a very difficult procedure. So that's challenge number one, is the availability. Number two is the cash to close, the amount of reserves or amount of savings you got to come up with just to buy it. In a typical investment purchase, have to come out of pocket for 20% down. And this is regarding a single family home or a duplex, triplex, or fourplex. Doesn't matter. 20% down is a typical down payment. If you're trying to target a $250,000 property, 20% of that is $50,000 plus closing costs and escrows. You're probably talking about cutting a check for $65,000. Most of us do not have that. Let's cut through all that. I'm going to show you the strategy that I would say is your only and best option to try to accumulate, in this case, single family homes over time, and to build wealth and to build your financial security. So in this scenario here, we're going to use a strategy of trying to buy 5 homes over a 10-year period. That may sound very aggressive to some of you. That may sound not aggressive enough to others. But that's very achievable, and that's achievable at almost any age. So in other words, you could start this strategy if you're just coming out of school, you got your first job, you're 25 or so years old, or you can use it when you're 55 years old. So let's assume, again, a 10-year period, you're going to be purchasing 5 homes. So let's get into that strategy. So inherent in the strategy is, number one, is you're going to be using probably an FHA loan. Why an FHA loan? Because it's going to allow you to maybe have potential down payment assistance and maximizing of your seller concessions. Why do we care about that? Well, we care because in my earlier example of the investment property, at $250,000, if you recall, our cash to close, the amount of capital you had to come up with was about $65,000. Here, with an FHA loan, if we get any kind of seller concessions and down payment assistance, I generally can get the check that you'd write at closing, your cash to close figure, between $5,000 and $10,000. So that's very manageable, $5,000 to $10,000 on about a $250,000 to $300,000 home. Hopefully that's available in your market. So strategy number one, you use an FHA loan. Of course, you identify a home. You're going to purchase that as a primary residence. That's critical, of course. You're going to actually live in this home. So that allows you to have that 3.5% down FHA loan with the seller concessions, as we mentioned, and potentially down payment assistance, and get you in at a very small cash to close figure. You live in it and enjoy that house for up to, say, 2 years, and then you rinse and repeat. You target another home, 250, 275 to 300, 325 at this point due to inflation, 2 years later maybe, and you purchase that as well. But now you don't sell your previous home, you rent out your previous home. So you're going to be capturing market rent on your previous home, and now you own your second home. We're going to repeat this for 10 years. You're going to buy 5 homes about every 2 years, and yes, you will be moving. And so that does require flexibility, of course, on your part and some family planning if you're a family and have kids. So this strategy probably works better with single people. I've seen single people use, they call it house hacking, and to build a significant portfolio in a very short amount of time. But let's get into the numbers and the projections of how all this looks after 10 years. So let's make a few assumptions for our scenario of buying 5 homes within 10 years. And the first assumption is you make about $80,000 now, household income, either combined or otherwise, or up to about 110. This strategy can work up from about $80,000 to $110,000 household income. Works great. And let's talk about assumed price points. We're going to start off year number 1, buying a home at $275,000. Starting year 3, $290,000. Starting year 5, $305,000. Starting year 7, $320,000. And lastly, starting year 9 at $335,000. Why? Because we're adding inflation of roughly 3%, maybe 4% as we go, make it all realistic. Okay, so let's drill down into the first couple of years when you first buy your first home with an FHA loan. And then after the end of the second year, when you're acquiring your second home and keeping the existing one. Let's look at the actual monthly mortgage payments relative to what your hypothetical rental amounts will be. And from there, we can then extrapolate forward using, assumptions and see what year 10 looks like. And then we're going to look at year 20. It's going to be a vastly more attractive scenario. So let's buy your first house. Let's assume you're buying in January of 2025. That's a good starting point. And as we mentioned earlier, our example of $275,000 purchase. Yes, I understand in some markets that's not going to work, but plenty of markets will. Certainly the state of Texas and lots of other states, you can get a pretty good home, starter home for $275,000. Nothing wrong with that. With an FHA loan as a primary purchase, using seller concessions, as I mentioned before, and possibly down payment assistance, your cash to close, the figure you're going to write at closing, is going to be between $5,000 and $10,000. I can get you down that low. You're into your house, and here is a mortgage calculator snapshot showing how much that was going to look like in today's rates, roughly. And by the way, I'm going to assume a 6% rate all the way through all my examples. Why? Because that's an historical rate. Yes, we were at historical lows in the early 2020s, but we're no longer there. We're back to more historical rates. So 6%, which you can almost get now if you have a good credit score, is a good number going forward. Or your monthly mortgage principal and interest, your property taxes, property insurance, your mortgage insurance, your HOA dues, all total on about a $275,000 purchase, about $2,275, as you can see there. That's the starting point. You're enjoying your home for the first couple of years, and now it's time to buy home number 2. So fast forward to 2 years, January of 2027 in our example, now you're buying a second home for $290,000. Only this time, you're not selling your existing home, right? You're going to keep it, and you're going to rent it out. What would the rental income be expected on that previous home that you just moved out of? In our market anyway, here in Texas, extrapolating 2 years from now, increasing rates about 3 or 4%, your market rent's going to be about $2,300 on your existing home, on your previous home. Remember, our payment was $2,275, and if we're collecting $2,300 worth of rent per month, then obviously we have a very small cash flow, maybe $25. But let's assume 0. So basically, let's assume a cash neutral. So now, at the start of your third year, you own your second home, and I'll show you the payments on that. You have an existing home that you bought 2 years prior whose rent is now covering your mortgage payment and property taxes, the whole enchilada. So now you're going to be gaining all the equity as that house continues to appreciate over time without really spending any money on it. As we assume your market rents going up every year to cover your mortgage payment, that first purchase you made of $275,000 in 10 years, assuming a 3% appreciation, which is very low. Most houses are appreciating more than that, but let's just call it 3% from 2025 to 2035. Okay, that $275,000 house is going to be approximately worth $370,000. So you're picking up $95,000 worth of equity alone just in your first purchase. And meanwhile, all your mortgage payments are being covered by the rent. Regarding financing for your second home, so let's go forward to 2027. You already own your first home. You bought it at $275,000. Now it's January of 2027. You want to buy the next house at $290,000. But you say, well, Kevin, I'm only making about $100,000 household income. How can I afford two mortgages? Well, you probably can't, but here's the good news. The good news is this is how it works. The underwriter of the lender is going to accept the rental amount of whatever that current market rent is on your existing home. They're going to take a factor of that, usually 75% of that number, and add it to your income. So for example, you bought that home for $275,000. In year three, starting year three, you're going to rent it out for $2,300 a month. You take $2,300 a month, you multiply it by 0.75, and that added income is going to be added to your existing income on a monthly basis. So you're getting credit for that market rent. That they send an appraiser out to the property, they do a market rent appraisal, and the underwriter will look at that report and take the lesser of that market rent that's shown on the appraisal or an actual lease that you might have in place at that time. And they're going to use that, multiply by 0.75%, and they're going to add that to your income. So you won't have any problem taking on two mortgages. So let's go now from year 2029 forward to all the way to the 10-year mark. In 2029, you're picking up your third home. And now you're renting out your second home. Your first home was a break even for a while, and now the rents are increasing, and it's probably cash flowing $100 to $200, not a big deal at all. And your second home, which you've now rented, is breaking even. Not so exciting just yet, but now you own your third home already, just after start of the year 5. So let's go all the way to year 10 in the year 2035 in our example, and you've got 5 homes under your belt now. And guess what? Your cash flow, your net cash flow from rentals as they've increased with inflation is now about $1,300 per month. Not bad at all. And your net worth, the difference between the market prices of their homes and your note balances, is about $480,000, almost $500,000. So you've got almost $500,000 net worth just on the first 10 years alone. Now let's go out 10 more years to year 20. Things start getting super exciting. Your net cash flow at this point from your rents, as they continue to go up and your note balances continue to stay stable, is about $5,500 per month. You can probably retire at that point if you wanted to, because now you've got $1.8 million worth of equity across your 5 homes. That's at year 20. Let's go to year 30. And most of those mortgages have been paid off if they're not close to being paid off. And your net worth is now between about $4.5 million and maybe $5 million. That's some serious wealth, my friends. And your net cash flow across your rentals, because now those mortgages are gone, it's about $15,000 a month. Now tell me, you can live off of $15,000 a month just with these rentals. And it's all because you made some great decisions early on to try to acquire just 5 homes over 10-year periods. Now, your situation may be different, of course. You might get more aggressive. I've seen people do 10 homes in 10 years. A lot of times they're military and they use VA loans and so forth. So you can still do it with an FHA. Or do it every 3 or 4 years, whatever the case may be. But pick a strategy. Let me help you out and watch all your riches grow. I'm Kevin Fagan on the Mortgage Patriot, on your side. Make it a great one.